And welcome to today's virtual webinar on unified risk and performance. We're excited to have so many participants from so many firms present for our discussion today. At BISAM, we have always been focused on providing the best quality performance analytics across the enterprise. We've watched our customers' perspective and needs evolve to include ex-ante risk in the recent past and be more inclusive of portfolio analytics rather than just performance analytics. Through our acquisition of FinAnalytica and their Cognity platform, we're creating the next generation platform to integrate the results and the portfolio operations. We're thrilled to advance this conversation a bit further today with our esteemed panelists. Before we start, I'd like to review a few ground rules so you know how to participate in today's event. You'll have the opportunity to submit questions to today's presenters by using the questions pane of the control panel. You may send in your questions at any time. We will collect these and address them during the Q&A session at the end of today's presentation. We'll begin by introducing ourselves, and as we do, we'd like you to answer the poll question you'll see on your screen so we can learn a little bit more about you. I'll start by introducing myself. My name is Sean Murray. I'm the Director of Product Strategy for BISAM. I've been working at BISAM for 4 years, first as a solutions expert, and now as the link between our clients, the market, and our development teams. Peter, can I ask you to introduce yourself?
Yes, I'm Peter Ellis. I act as an independent consultant these days, but in previous lifetimes, I've worked for asset management companies, for consultants advising asset management companies, and for vendors, one of whom was BISAM. And I still act as a strategic advisor to BISAM on certain matters.
Thank you. And David?
Thank you. Dave Spaulding with the Spalding Group. I am the CEO, and our firm is in its 27th year. And I've been involved with performance for something over 30 years. Do all kinds of things, performance and risk measurement related.
Great, thank you. And Daryl?
Thank you. Daryl Bradford from Acadian Asset Management, manager within the performance and attribution team. For background, Acadian, we're a global quantitative investment firm headquartered in Boston. We have just about $70 billion under management. The performance team here consists of about 10 members, and we're responsible for all things performance, calculation, attribution, risk, reporting, custom analytics, as well as GIPS compliance. And I've been with the firm here for just about 10 years now.
Great, thanks, Daryl. We'll continue straight into our first topic for today, called History of Performance and Risk. And again, we want to open with a poll question. So as we open up the question, if you can quickly indicate, have you or are you considering integrating your risk and performance analysis teams? And we'll leave this question open for just a quick 10 seconds. So lots of answers coming in on already integrating the analysis teams. Okay, thank you for that. So without further ado, Peter, I will hand it over to you for your presentation.
Okay, thank you, Sean. So in this roundtable, we are going to be discussing the unification of performance and risk. But actually, we should probably start the discussion with the question, why were they ever separated in the first place? Risk and performance are really the constituents of an investment objective. It's the combination of a performance target and a risk level that together define the outcome that an investor wants to achieve. So it's wrong to focus on one and not also on the other. If you do that, then there's a chance that you'll fail to meet the performance target, or that you will exceed the risk appetite of the investor, or maybe even both. So what puzzles me is why, or what may puzzle you, is why we have not been taking a more holistic approach to risk and performance up to now. Well, the separation happened a long time ago when the asset management landscape was different. It was a time of lower volatility, a time when portfolios held a smaller range of asset types with simpler characteristics. Investment objectives were more straightforward. Investors went for equities if they wanted to get a higher return and were prepared to take a bit more risk. They went for bonds if they were happy to take lower returns but get a bit more certainty about the outcome. And back then, investor expectations and behaviours and preferences were also different. Today, behaviours and expectations are calibrated by target-driven investment objectives. And what I mean by that is that investors don't just want to do better than an index these days. They want a defined value to be delivered over a defined period of time. And that means that investors and their advisors don't just want to know how much performance has been delivered and how that performance was delivered. They want to know whether their investments are on track to achieve their objectives. And they want to know something about the risk that their objectives won't be achieved. And another change in the asset management landscape is that investors want more value for money from asset management firms. It's one thing to pay high fees when funds deliver high returns year on year, but it's very different when, as we've seen in recent years, funds fail to deliver good returns over a sustained period. Investors have become much more demanding. They want to know what investment managers are doing to justify the fees that they're receiving. All of this is resulting in higher levels of governance of investment processes, and this is creating a move towards greater integration of performance measurement and risk analysis. Now, what we're showing here on this slide is some insight into these trends that was provided by a survey that I carried out some time ago. What you have on the left-hand side there is an indication of what the current practice is with regards to the use of systems for performance, ex-post risk, and ex-ante risk. And what you can see from that is that very few asset management organisations use the same system for all three. And in this survey, we collected information from both asset managers and asset owners. And the survey universe was split roughly between the two. And what you can see from that is that half of the organisations that took part in the survey are using a different system for performance, ex-post risk, and ex-ante risk. Now, in that survey, we asked organisations if they were considering or intended to change their system configuration over the next 3 years, and 39% of them said that they were actively intending to change the system configuration within the next 3 years. And what you see on the right-hand side is where they said they were intending to go. And what you can see from that is that 30% of those who are intending to change their system configuration are intending to move to the same system for all three. So Sean, can we have the next slide, please? Now, this is some further insight which came from another survey. And this survey was actually run by BISAM, and it collected information from asset managers rather than asset managers and asset owners. And what was found in this survey was that there's a trend for performance teams to calculate ex-ante risk. The trend has more momentum in North America. The majority of C-suites, by which we mean CIOs, COOs, CEOs, are mandating performance teams to calculate ex-ante risk. In other words, there's a direct pressure from the C-level for performance teams to extend the scope of their responsibilities to include ex-ante risk. And we found that it is more likely to be the case in North America and in mid-sized managers that that mandate would come from the C-level. When it comes to the benefits of integrated systems, there's perceived to be more benefit to investment teams than for operations, and more benefit for operations than for client servicing. And in all cases, whether it's investment, operations, or client servicing, the biggest perceived benefits are associated with shared data. So together, these surveys provided evidence for two trends. First, performance teams are extending the scope of their responsibilities to include the assessment of ex-ante risk. And second, the industry is moving towards a more holistic approach to the measurement, analysis and reporting of performance and risk. So Sean, back to you.
Thanks, Peter. So to open up the questions, Peter, I'm going to start with you, and I thought I would share the results of the poll that we did. A large concentration of the attendees have already integrated their teams, but a large portion of them have not. So a question, with a large people still being undecided and a large portion of our attendees saying no, what makes them decided, or maybe said a little bit differently, how can you advise the client can decide, and how will they go down this path of the integration of the two teams?
Well, I think the first thing to say is there's no best practice in this area. We are, to some extent, breaking new ground in looking to unify performance and all aspects of risk measurement and risk analysis. But I think I think each organisation will have to assess individual pros and cons, and that's going to depend what those pros are and what those cons are. It's going to depend on the motivation behind the change. If the main driver is extending the scope of performance team to include ex-ante, then I think there will be a natural inclination towards a single system. But there are few platforms that can provide strong support for performance, ex-post risk and ex-ante risk, and that may be part of the reason why some people haven't quite decided yet. Risk analysis is never going to move completely out of the front office because it's an integral part of the investment process. But what I think we are going to see is more independent monitoring of ex-ante risk in the performance function outside of the investment team to give that independent governance. So to get back to your question, Sean, I think it's because there's no best practice, and I think it's because different organisations have different motivations for looking to unify performance and risk.
Great, thank you. And Daryl, a question for you. Did the findings of Peter's survey and the trends of the industry in general as you see them, are these resonating with some of the changes that have been occurring at Acadian?
Yes, they are. So I think I'd say we sit somewhere in the middle here. Our performance team here focuses on ex-post risk, whereas our portfolio construction and management teams focus on ex-ante risk, because that's part of the risk model and portfolio optimization and construction processes. That being said, we work very closely with those teams, and I guess risk in general would even be more broad as to our compliance team, certain mandate restrictions or enterprise risk. We certainly sit in a unique situation where we're working with that team as well very closely. For ex-ante, which I feel like is, to Peter's findings, potentially something that will be coming down the road, although separate, we still run, say, VAR analysis or stress testing scenarios, things of that nature with our portfolio management team for certain requests, which I think is the direction we're moving towards, and is certainly more recent. And to Peter's comments earlier, I think it's a matter of a decision that varies from firm to firm, whether it be based on the size of the firm, the scale, the products offered, investment styles, or just the best of breed approach where firms want to have the best accounting system, best performance system, the best risk model, and certainly the question whether it's to build or to buy for customization. So it certainly varies across the industry, and I think it's worthwhile having this conversation for sure, as firms are kind of moving in different directions with the changing landscape.
Great, thanks, Daryl. Our next presentation is from David Spaulding on risk-adjusted performance attribution, why it makes sense and how to do it. So David, over to you.
Thank you. When we talk about unifying performance and risk, we can do this from three legs, if you will. We can look at it from three ways. One is organizationally Another is systematically. Peter touched on these. And the third is formulatically. There's a formula that combines them. And we've been doing that for 50 years with the Sharpe ratio, Trainer ratio, and so on. And what I'm going to talk about is doing it from a performance attribution perspective. So as this slide suggests, we'll talk briefly on why we'd want to do that. Give a brief overview of the M-squared risk-adjusted measure, and then go through an attribution example. Okay, so why should we change to a risk-adjusted attribution approach? Or that is, why should attribution include a risk-adjusted return? Next slide. If we ignore risk contribution to performance, then the problem is that when we look at our effects, and really specifically selection and interaction, they're going to be perhaps overstating the contribution that those decisions are making. And that's the problem. We know risk has the risk difference between the portfolio and the benchmark can contribute to performance. And unless we isolate it, we're going to be basically overstating. So next slide. We know that attribution, the role of attribution is tell us how the different decisions that managers are making are contributing to our excess return. And if we ignore risk, then we're actually providing a less than accurate presentation. Next slide, please. So with what I'm proposing is that we do risk-adjusted attribution and that we use M-squared. And next slide. And why M-squared? Well, we could consider these other risk-adjusted measures like Sharpe ratio, Trainer ratio, and so on. M-squared is superior, in my opinion, far superior in that it provides a very intuitive result. And I want to spend a few minutes going through that method. The next slide. M-squared is just a funny way of describing the authors of it, which are Franco Modiani, who won a Nobel Prize in economics. He passed away a few years ago, and his granddaughter, Leah, who is a portfolio manager. And basically what they saw was that the measures that we typically use against Sharpe ratio, information ratio, and so on, don't really provide meaningful information. And so what they proposed was that, just in general, the concept is, if we can get the portfolio's risk to align with the risk of the benchmark, and then there's a corresponding adjustment in the return, we will then have a true risk-adjusted return measure. Next slide. And so this is actually some text that Leah had sent me some time ago, and I think it's very helpful. And so what we're doing with this approach, let's say the risk of the portfolio is higher than that of the benchmark, then what we want to do is to lever down, as using her term, reduce the risk of the portfolio so that it matches up with the benchmark. And we do that by, now she said by incorporating cash. We're actually going to incorporate the risk-free rate, some of the risk-free rate into the portfolio, thus reducing the portfolio's risk. And how do we do that? Well, the next slide shows the formulas we're going to use. And in this case, the risk measure we're using is standard deviation. By the way, the Modianis are risk agnostic. They don't really care which risk measure you use. But here I'm using standard deviation. And so what we do is we have a ratio of the benchmark standard deviation, okay, so sigma R sub B for benchmark, divided by the standard deviation of the portfolio, sigma R sub P, that is the percentage of the original portfolio that we will retain. And then 1 minus that amount is how much of the risk-free rate we're going to take. Okay, so now let's look at the portfolio. So here's the portfolio, and you can see it's been allocated fairly evenly across the 10 sectors. I took a $500,000 portfolio, spread out pretty evenly. I did not use fractional shares, so we do have a little bit of residual cash. Next slide. The data comes from the S&P 500, and what I did is I randomly selected 5 securities from each sector and allocated evenly as well across those 5 securities. The data actually comes from December 2010. As this slide shows, I use Brinson-Fockler, no cash flows, so I'm going to tie out with the excess return, so there won't be any residual. And the standard deviations are based on the prior 36 months, and I kept the portfolio the same for that period. Now, the next slide shows what we would get if we use a standard approach today. So any of you that are using Brinson-Fockler, this is familiar to you, and this is what you would be showing. We outperformed the portfolio by 41 basis points, and we see the results, and they show that we're not very good at allocating. We lost 2 basis points. We're not particularly good at selecting either, negative 19, but we're really good interactors. So thank God we interact well. We got 62 basis points. And we see we tie out, so there's no residual. Okay, the next slide shows the math we're going to use in order to make our adjustments. So this table shows the standard deviation, and we can see the portfolio has more risk than the benchmark. If you could click now. And the first line here shows the ratio that we're going to keep of the portfolio. So the standard deviation of the benchmark over the standard deviation of portfolio says 86% roughly. And the balance, about 14%, is how much we're going to take of the risk-free rate. And I'm going to use the same ratios at each sector level as well. Okay, so let's move to the next slide. And I show here how we apply M-squared at the portfolio level. And so we're taking the first ratio, the benchmark divided by portfolio standard deviation. This is how much we're going to keep of the portfolio. So 86% of that 7.09% portfolio return. And then we're going to take 1 minus that amount, or about 14% of the risk-free rate. And you can see that we've adjusted the portfolio return from 7.09 to 6.16. Okay, so that's our risk-adjusted return. Next slide. And this is how, just talking about M-squared, this is how we would present the information. We're saying that the portfolio had a return of 7.09 pre-risk. On a risk-adjusted basis, it drops to 6.16. Okay, let's go to the next slide. Here we're showing just how I would apply that same idea at the sector level. So the same formulas being applied, but now it's at the sector returns. And we see that the sector return in this case has dropped from 6.23% to 5.41. The next slide. Now we're showing how the selection effect is going to be adjusted. So instead of using the portfolio return, we're using the risk-adjusted return, or M-squared. So that's the only change here. So we're just substituting the return we just calculated, the risk-adjusted, into our standard Brinson-Fockler formula, and we get our result. Now the next slide shows how we used M-squared in our as a substitute for the portfolio return. We now have adjustments to our effects, really just a selection interaction, because they're the ones that use the portfolio return. And we see that now we actually have underperformance, which goes back to the earlier slide where I showed that on a risk-adjusted basis we did underperform. But now we have meaningful information that takes risk into consideration. You can see that I added a column for risk. Next slide. And this shows a comparison between what we showed earlier with the portfolio return and now we have M squared, and it shows the contribution from risk. Next slide. And here we can see we compare the results, and you would expect there are going to be some differences. So let's just move through the next slides quickly. To me, risk-adjusted attribution is really a necessity. It's an oversight that we haven't been doing this for some time. Next slide. If we ignore risk, then we are, in fact, either unfairly penalizing or rewarding the manager for the contribution that is actually coming from the risk component. Next slide. To me, M squared is the way to go because it's meaningful. And finally, there is an article that we wrote on this. I wrote on it, and I apologize for rushing through, but we do have limited time. But the article is available if you email me. Next slide. I'll be happy to get you a copy. And you could read it a little slower than I went through it. Thank you.
Thank you, David. Very good job. So first question, volatility is consistently high, and this approach is a very pragmatic method of exposing the investor to true manager alpha. So when you think about market adoption of the approach, you talked about it a little bit in your paper, who do you think it can more immediately benefit, and who do you think might lag behind the rest in terms of adoption?
Well, I think it benefits the clients because they understand the contributions that's coming from risk, right? So they're used to seeing Sharpe ratios and information ratios, which again, I think are far behind M squared as far as meaning. The M squared approach provides the same information, but in a much better way. But this is now extending it to attribution, so they get to see when the manager is making certain claims, how much of it is actually coming from the selection decision and how much is actually coming from that over use of risk. And so I think that really is the benefit for them. And I think the management should also want to see this. I don't think anybody should really be lagging behind here because I think it's a win-win for everybody. The managers should find this to be a much better way to understand the contributors to their excess return.
So do you think that the clients will pull this from their manager, or do you envision that the managers will push this to their clients?
That's a very good question. I think the real win, the way to get it done is to get the clients to be pushing. That's how we got GIPS to be successful. So if clients could say, hey, I like this idea, and turn to their managers and say, how come you're not giving me a risk-adjusted attribution? That'd be the easiest way to get this to work. Because I think that, although I think that for the portfolio managers to do this as well and say, listen, we want to provide greater insights to our client. To me, attribution is all about insights. That's really a fundamental characteristic of attribution, providing insights into what's going on. And this is just extending them into a whole new area of the contribution from risk.
Right, thank you. And Daryl, a follow-up question for you. Many investment firms have explored this topic in the past. It's clear that there's a benefit to the managers and the clients, as we've just been saying. Thinking about Acadian or your perspective, what roadblocks have you encountered, or do you anticipate encountering as you think about incorporating this type of analysis at Acadian?
Yeah, so there's certainly a true benefit on all sides, and although not David's approach, we've implemented aspects of risk-adjusted attribution in a few different layers. Now, being a quantitative firm, we rely very heavily on regression-based factor attributions as well as standalone risk attribution. And these are obviously critical tools in managing our portfolios, providing feedback to our front office as well as to our clients, and to David's point, to provide as much transparency and insight into these portfolios, the composition of them, and the decisions that we made. Now, we typically analyze results that are risk adjusted for beta, size, volatility, as these are elements that are constrained within our portfolio construction parameters based on a combination of the clients as well as the firm's preferences and risk budget. And this is done in a way to help us isolate the drivers of those portfolio returns and ensure they're being attributed to the correct sources. There's a few other examples of kind of risk adjusted attribution that we do that I'll table for now. And as far as the roadblocks, I think for one of the main things, and David mentions it in his paper, is the fact that the return that we're attributing to won't tie out to the published return that the client's seeing. Now that seems, on the surface, well, okay, we're not trying to target that return. It's a risk-adjusted return, but it tends to be a bigger deal. And the fact that we're kind of immersed in performance and attribution on a daily basis, the clients have different levels of sophistication. They have different wants and needs from what they're seeing from attribution. So already, if they're receiving factor-based attribution, different styles of Brinson attribution, and even within Brinson, are we including currency? Are we breaking out selection or interaction together? Those minute differences, it can be a lot of information. So I think there's an educational aspect and the communication that certainly needs to happen. And to David's point, as far as the client or the manager, it's kind of up to, I would say, the firms to decide on what the client needs are from any external attribution to make sure that it's communicated. If they are receptive to it and want to see more of it, then absolutely. We tended to take the approach to listen to our clients, and it's worked well for us in the past. And another potential constraint that I think all performance teams are certainly facing is, resource and budget constraints. But largely, it's more the adoption aspect of it.
So it's almost not unlike, we've seen this in other topics, things like fixed income attribution, which was once, solely for the use of the portfolio managers, and it became more and more a client requested analytic. And, with that comes education, not only on what the analytics are and what the results are, but also the differences of results from firm to firm and, even solution to solution. So it strikes me as being very similar in adoption from an education perspective as topics like that.
Absolutely. I think the client wants to make sure that what they're seeing they can understand and they're in even more, I guess, uniform, so that they don't think they're seeing something that someone else may be doing in a different way, and then they can no longer compare apples to apples across their different managers and funds. So it certainly is something that and hopefully David's approach is the way to go to get some consistency behind this approach.
Great. Well, thank you both for that conversation. So we're moving into our last session here in the webinar. And again, as before, we want to launch with a poll for you guys to participate. And so the last presentation is really more of an interactive session, a Q&A session with the experts. But again, the question we have for the audience is really, in your opinion, what do you all see as the main benefit of integrating risk and performance analytics? So, here we presented today a view on the team structure, a view on the solutions, the pros and cons and benefits really of those two components, and then certainly some new thinking on risk-adjusted attribution. So just interested in what the attendees think is the main benefit. So we will close the poll, and I'll quickly share the results. So the overwhelming majority provide front office with better analysis for investments. So certainly aligned with everything we've been talking about today. So we'll go in kind of a little bit of a round robin here on the questions. And David, I want to start with you. So thinking about, you have obviously connections to your customers and, many industry leaders doing this for such a long time, being such an expert. Maybe you can start just by sharing your perspective on, how you've seen performance and risk really evolve throughout the years.
Well, it's an interesting question. I guess the evolution has been in a lot of different directions, one being how we measure risk, because we keep finding out that the ways we're measuring it are not doing a particularly good job, right? The '08 crisis we went through, I think a lot of people thought that value at risk would be an ideal way of understanding what the risk was, and it failed for, I guess, understandable reasons, but it failed to really alert us about how bad it could be. And so we're now trying to find better ways from an ex-ante perspective, such as liquidity risk, to try to understand really what the risk is. Clearly, we're seeing a greater appreciation for ex-ante, but it has not caught on, I don't think, to the extent that we might have expected, and there are probably a lot of reasons for that.
So I guess another question for you. Sorry, I was just going to say another question. The poll results are, kind of indicating that people think the front office is really driving a lot of the demand around integrated performance and risk. Do you see that as being the biggest benefactor, or if you think about ex-ante risk and the client's view, do you think there's a march into the client with this type of information too?
I think for both. This is a topic that frequently comes up at our performance management forum meetings, at our conferences. This is just, you can expect somebody raising this question about integrating. And so, and I'm not surprised that the first option here was the one that got the most votes, because I think that truly is the greatest benefit, that by integrating, which is something, again, we've been doing for 50 years, we get better insights. And that's exactly what the idea of risk-adjusted attribution is about, to provide better analysis. And so I think it's very good for the front office, but I think it's also good for the client. So clearly, there are huge benefits. We've talked about for years that returns and risk, or that the metaphor is that they're just they're the same coin, just the opposite side. And so bringing them together clearly provides many benefits and many opportunities.
And David, just a last question. So in your conversations with people in the industry and in your events, is there a profile of a firm that is leading this? Do you see this, more, let's say, adopted or accommodated in a certain type of firm, or is it just a little bit kind of random almost?
Well, I would expect that it would be more common with the larger firms that have greater investments in risk, but I haven't really done any research to see that. We saw in the earlier poll that you showed that I think it was roughly 35% have integrated the departments. But if we were talking about integrating risk and returns in a formulatic way, everybody does that, right? Everybody's calculating Sharpe ratio. Everybody's calculating information ratio. So that is already a standard today. It's going beyond that from an organizational standpoint, going beyond that into attribution, and going beyond that from a systems standpoint, so that you're getting all that within the same system, is really the area where we could see a greater movement, I think.
Right. Daryl, switching to you, maybe you can give us sort of the practitioner's view here. So help us understand the day-to-day challenges of supporting the front office, and how this notion of risk, whether it's ex post or ex ante, has crept into the requests you are routinely dealing with.
Yeah, we've certainly seen it more common as of late, and I think, in our team, what we're looking for as far as credentials and building skill sets, the CIPM and CFA, but also the FRM, which is extremely helpful in understanding and being able to speak to risk a lot. One of our kind of core products, that's one of our fastest growing products now, is managed volatility strategies. So at Acadian, we're one of the kind of an early mover in this space, that we have over a 10-year track record for our global managed volatility product. And why that's important is because these strategies are designed to capture returns similar to that of a benchmark, market cap-weighted benchmark, but with significantly lower volatility and superior downside protection. So with that, we have a dedicated managed vol PM team, and in order to support them as well as our client base, we've built a custom, I'd call it Brinson style attribution for these strategies, which look at beta as well as volatility, broken out in quintiles, and we can run those versus both a cap-weighted as well as a managed volatility benchmark. So from there, it's simple to see how our portfolio is positioned within the lowest beta or lowest risk stocks, as well as how is the benchmark positioned, how do those securities actually do, and then broken out in attribution, selection, and allocation effects as well. So it's an extremely useful and intuitive way to decompose returns, look at the composition of the portfolio, as well as the active return from a beta and risk perspective, which is, I'd say, required now for these products, and is certainly requested anytime anyone wants to look at the attribution or the sources of return for these. And again, I think we're obviously seeing more sophisticated investors, more sophisticated products, more questions, and this is just another step in that direction, and being able to not only handle those questions internally, but also externally as well.
So Daryl, there was a question from the audience that I picked up, and I'll ask it now instead of asking it later. And the question was around comparing ex post and ex ante results. So if you think about the strategy you just described or others, are you doing any kind of reconciliation of ex ante, let's say, risk budgeting versus ex post risk results at Acadian?
Yeah, right. So almost efficacy testing. So not only that, but there's also the ex ante risk targets, as well as, or almost on a moving basis, right? So what did that look like, 3, 6, 9 months ago, as portfolio changes are made within the construction process? How do those change, and then what do the results look like on the other end? So to David's point, it's the ex post is a little bit easier. Everybody's doing that. So there is testing and reconciliation that's being done in those where there are either differences. They're certainly noted and either incorporated into any type of changes, but more this is intended, and here is the explanation as to why this is happening. Potentially there's less dispersion in forecasted returns, and then from there it would be a matter of looking at such statistics as active share, and then making sure that we're still getting access to the alpha within the portfolio that we want on a risk-adjusted basis. So yes, it's certainly being done.
So I guess a broader question then, if you take a bit of a look backward and maybe a bit of a look forward, so, again, from your perspective and from Acadian's perspective, how has this evolved over the last, 1 to 2 years? And based on that, where do you see it evolving to in the next 1 to 2 years?
So I think it's certainly been a steady evolution. And I think it's certainly going to move forward, right? And this is a matter of the listening to what our clients want, as well as what is being done within the industry, right? Obviously trying to be at the forefront of the industry. So it's certainly something that I think is only picking up speed. And I think maybe to draw a parallel from the past, say, 2, potentially 3 GIPS conferences, there's been a lot of focus on more guidance along the lines of risk, which seemed to be a large focus at this most recent one here in Boston. So I think everyone is kind of craving for fuller and more practical guidance, across the industry. And hopefully that's the direction that we're going in, and we know that there's certainly room for improvement. So I think one, exciting from an opportunity perspective as well as learning and growth. So hopefully good things to come on that front.
Mm-hmm. And if I remember from the conference, as they're thinking about formalizing the requirements for 2020, there's sort of an evolving risk requirement in that, yes?
Correct, yep. So I know there was one of the last presentations on that, and we're always left with a little bit of a cliffhanger wanting more. So you're absolutely right, though.
And Peter, coming to you, first question, what do you view as the main benefits of integrating risk and performance analytics?
Yeah, well, one thing that we haven't really brought out so far, I think, in the discussion is that if you're an asset owner or an investor, then risk is a very real thing in that if there's a risk that you won't have enough money to meet your future needs, whether you're an institutional pension fund or just an ordinary person investing in the stock market. If you're an asset manager, then if you get risk, if you manage things badly, and if you don't manage risk properly, then technically it's not your money you're losing. You'll lose reputational. There'll be reputational damage, and you may lose clients. You may fail to win new clients. So there's a different dynamic, I think, around integrating risk and performance for asset owners and asset managers. But I think that the main benefit of doing it is probably common across both. And I touched on it earlier, and both David and Daryl have touched on it at various times in the discussion. It's the independent governance of risk. We've accepted the need for independence in the calculation and analysis of performance for many years. Nobody now would go to the front office to get an official performance result. There's every reason to extend that principle to the assessment of ex-ante risk. There is an absolute need to have independent governance of the risk budgeting and the risk profiles that investment managers are adopting in their portfolios. And so that, I think, is fundamentally the main benefit that comes from unifying performance and risk. It gives us that independent governance, that independent monitoring. Having then established that and having got that independence of monitoring and analysis, we can then feed that back into the investment process, as both Daryl and David were indicating earlier.
So a follow-on question for you, and if you put on your creative hat for a minute, where do you see this going? So if you think about what people might use an integrated system for, right? And you have a very sophisticated portfolio, let's say, functions that you can do within a risk system, and if you attach those to a performance system, if you think about the functionality that this could provide, where do you see this sort of evolving to? What would people be able to do that in the future that they can't do today?
Well, I'm not sure that they'll be able to do things in the future that they can't do today. I think that it will be easier for them to do things in the future that they would like to do today and maybe should be doing today. I mean, there's nothing to stop people doing fairly sophisticated things, but you're going to have to do it in Excel. You're going to have to consume a fair amount of effort to do it. I think we'll see much greater focus on risk-reward ratios. I mean, that's essentially what David was talking about, a risk-reward ratio. When managers are charging fairly high fees for active management, then they need to be able to demonstrate that it is their active management that is delivering additional value in order to justify the fee and in order to reassure the investor that their risk appetite is being managed properly. I think we're going to see a lot more demand from investors for transparency around investment processes and the risk that their investment objectives will not be met. If I get really creative and maybe go a bit too far, I think that where the industry is moving is towards some kind of value-based assessment of how the portfolio is going to deliver, or what the portfolio is going to deliver. I mean, performance teams have an ex-post mentality. Traditionally, they look backwards. They look at what has happened and they analyze what has happened. But investors really live in an ex-ante world. They're concerned about their future needs and whether their future needs are going to be met if they follow the investment strategy that they have been following. And looking backwards, as we've discovered over the past 10 years, looking backwards doesn't give you enough information to anticipate what's going to happen in the future. So I really think if we start to see much more unification, much greater unification of performance and risk and ex-ante risk, and we start to evolve some of those investment principles that Daryl was talking about, that Acadian are doing, I think that will take us towards an approach for both performance and risk that has much more of an ex-ante feel, which is more about looking forwards and saying, well, we think the investment objective is going to be achieved, or we think there is an X% risk that it won't be. And therefore, this is what we're going to have to do in order to keep us on track to achieve the objective. So I think ultimately that's where we're going.
Great, thank you. Just wanted to ask you all a couple questions from the audience. We took one already to you, Daryl, on the risk reconciliation. David, there's one for you, kind of under the topic of feedback that you've received on your paper, and the question is really around. It says you used ex post risk for the analysis. Would ex ante be more appropriate? So any thoughts there?
My initial response is it would not be appropriate. The performance is ex post, and we're doing ex post attribution, right? So we are wanting to know the way everybody does it today, right? Is you're looking historically and saying how did the manager decisions contribute to our excess return, and we're ignoring risk. Ex ante risk really doesn't fit into that. Now, there are ex ante risk models available, right? Risk attribution models, such as some that Jose Manchero has developed that look forward, okay? But if you're doing attribution as we do today, how did you do what you did? We're only looking backwards. So I appreciate the suggestion, but maybe if we were talking about ex ante performance attribution, I'm not sure what that would look like. I know that there is an attempt to say what is the future return going to be, and then to try to tie in the attribution to that. There might be some value in that. I'm a bit of a skeptic when it comes to ex ante. I'm not totally in Nasib Taleb's camp, the author of Black Swan, because I know people want to know what the future holds, but I think we have to recognize that whatever we predict, we're probably wrong. The question is, how wrong will we be? And we don't know.
And Daryl, maybe we'll just end with you on this and putting you on the spot a little bit. But you had, talked a little bit about how you, look at ex post and ex ante together. Maybe you can just sort of give us your view on, where you see that going, if they continue as two separate streams, if they start to kind of form a single conversation, just your kind of quick thoughts on that, quick closing thoughts.
Yeah, I'd say again, it probably is heavily dependent on the firm, the size of the firm, is it quant, is it fundamental, what are the products that they're investing in. So I think that our current setup now, where it is separate, it works very well for us. That being said, there's a lot of communication that goes on, a lot of sharing of data, participation in the same meetings, standards around those type of, whether it be a calculation or a risk model. So I think that works very well for us, but at the same time, for other shops, could it work just as well to combine the two and gain additional efficiencies? Potentially. But we look at it as kind of our main job is looking out the rear view and trying to provide as much insight from that as we can to the folks upstairs. So I think either approach can certainly work and may converge even more in the future, but that's kind of where we stand.
Great. Thanks, Daryl. So this concludes our presentation. I want to say thank you to you, our participants, and especially our presenters for this interesting discussion on unified risk and performance in practice. We would appreciate your feedback. It would be